most of the fourth turnings, or actually all the fourth turnings, basically happening at major long-term debt cycle changes, as Ray Dalio would refer them to. So that's the more financial or quantitative background of what happens. And generally, these things tend to feed on each other. So, for example, um, sovereign debt crises can lead to more geopolitical instability, and geopolitical instability leads to sovereign debt crises.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Buckminster Fuller, the famous architect and systems theorist, famously said, "You never change things by fighting the existing reality. To change something, build a new model that makes the existing model obsolete." Today's guest expert, Lyn Alden, brings an engineering approach to finance and investing and spends a lot of time looking for better models that we should consider adopting as both a society and as individual investors. Could our markets be designed to become more efficient and fair? Are central banks the best way to set monetary policy? And is there a better form of money than the current fiat currencies we use? We'll dig into all those topics and more today with Lynn. Lynn, thanks so much for joining us.
Thanks for having me. Always happy to be here.
It's always a pleasure, Lynn. A lot of people have been asking loudly on this channel for your return. You're going to make a lot of people happy with today's discussion. I got a lot of questions for you, including some questions about your brand new book, which I understand is selling really well. Congratulations on that. But before I dive into them, if we could just start at the high level question, I like to always kick these discussions with you off with, what's your current assessment of the global economy and financial markets?
So I think the biggest overall set of forces right now is the opposition between obviously the increasingly tight central bank policy, especially from the Fed, as they keep rates high, they reduce their balance sheet, um, being offset by the sheer amount of fiscal stimulus that is happening in the form of basically uncontrolled deficits. And what makes this type of period different than most other periods, except for going back to the 40s, is that normally, like let's say in the 70s, when you raise interest rates and you have very low public debt levels, the downward force you put on money creation from banks is a lot bigger than the upward force you put on your own government finances through higher interest expense.
Mm-hmm.
And then as you get more and more debt on the public ledger, um, that interest rate setting mechanism gets less balanced because now when you raise interest rates, although it does slow down bank lending, and we're seeing that, it also completely explodes the fiscal deficit through higher interest expense, which is a type of stimulus. And if you go all the way to, like, say, Japan's case, it'd be even more extreme, right? So the more public debt you have, the less intuitive that interest rate channel gets as a policy tool. So we have these kind of two very competing forces right now. And then, of course, the other side of that, or in addition to that, it's the rising geopolitical conflicts around the world. So while we have these domestic fiscal issues, the U.S. is now strategically, financially involved in two war fronts to different degrees. And the way I would phrase it, and I know that you've read The Fourth Turning, you're a fan of that book, but basically to put it in kind of more quantitative metrics, is most of the fourth turnings, or actually all the fourth turnings, basically happening at major long-term debt cycle changes, as Ray Dalio would refer them to. So that's the more financial or quantitative background of what happens. And generally, these things tend to feed on each other. So, for example, sovereign debt crises can lead to more geopolitical instability, and geopolitical instability leads to sovereign debt crises. It's kind of like when you're vulnerable, that's when things are more likely to happen to you because there's more opportunity for them to happen. And so that's kind of the geopolitical stage while we have this fiscal and monetary backdrop.
Okay, great intro. Gosh, lots to dig into there. I've talked on this channel, Lynn, about the fact that you've got the Fed and really the banking system jamming on the economic brakes, while at the same time you've got the fiscal side of the equation, the administration and Congress putting their foot on the fiscal accelerator, right? So it's pretty much, I think, what you started your answer with. Keep using the car analogy. You basically can burn out your engine by doing that at the same time. What's the risk here economically of doing that?
The risk mainly is that crowding out effect while you have that combination, because basically someone has to buy all these treasuries. It's currently not the Fed. It's not the domestic banking system. And with a strong dollar, it's not the foreign sector either. There's an unintuitive relationship there that if the dollar gets too strong too fast, the foreign sector actually generally stops buying treasuries. And if it gets disorderly, they could actually sell treasuries because basically they're in currency defense mode. They're not in reserve accumulation mode. They're in currency defense mode and servicing their debts mode. So what they need is dollars, and they can sell assets to get dollars. And so that risk is that all of this treasury issuance has to be absorbed by the domestic non-bank sector, which is households, hedge funds, asset managers, pensions, basically different pools of capital. And basically, it's a liquidity squeeze. It's pushing downward pressure on the private sector, which in some cases is good, some cases is bad. But the public sector is just completely not sensitive to interest rates. I mean, no congressmen are going to make decisions about things based on the Fed's current interest rate, like a business would. Um, and when we look at these big buckets of spending, there's the Social Security, Medicare, military. Those are and the interest expense. Those are the by far the biggest chunk of the budget. And they're all unpopular cut. And then now with the geopolitical issues, I mean, even defense is now it's more likely to go up than down.
Hmm.
And so the and then basically there's no appetite for major tax increases, especially when you have a polarized Congress. So the combination of nothing meaningful is easy to cut, and there's no meaningful way to kind of increase revenue. And so I think these deficits are set to continue. And so we are in that, as you said, that burnout phase, at least while there's still some pools of liquidity. So we're burning down reverse repos. That's coming back into the market. That's like the kind of the final source of liquidity out there.
Hmm.
And so basically we're in this kind of stall period until kind of existing liquidity is used up.
Okay, and what happens when that liquidity is used up? Basically, which of the two pedals do you think is going to sort of win out here in the end?
So I would expect the fiscal to win out, meaning that I think the central bank has to shape itself around fiscal rather than fiscal choices shaping themselves around the central bank. At the end of the day, those in charge of the fiscal lever can override the monetary lever. And what form that takes in, we'll see. I mean, this is obviously a complex, ever-changing situation, but a good model for this is the 2019 repo spike, which in many basically the Federal Reserve was doing quantitative tightening. There were an increasing amount of T-bills coming to market. There was no longer any reverse repo facility, and hedge funds were big buyers of treasuries, and they were using the repo market to finance themselves. And eventually, basically all that liquidity got tapped out, and the repo rate spiked, and then the Fed had to come in. First, they provided repo. Then they had to stop decreasing their balance sheet. Then they started, just buying T-bills outright. So even though it was a repo problem, they had to go and actually fix the T-bill oversupply problem.
Hmm.
Now that was politically, it was complex because their messaging was this is not QE, we're just buying T-bills, um, and of course there was officially not high inflation, so they had some covered. It wasn't like a necessarily a big issue. It did have market impacts. I think you could see a similar thing, maybe 2024. If they kick it a little further, maybe 2025. I would guess 2024, but we'll see. And then there might be a thing where the Fed has to stop reducing its balance sheet to basically you have a treasury market go liquid or something, kind of like the gilt market last year. And then basically you're in fiscal dominance where the central bank has kind of limited control of its own balance sheet size because there's just so much fiscal on the market.
Okay, a couple of things real quick. Can you just define the term fiscal dominance? I'm not sure every viewer knows what it is, but it's a true term that has implications in this current environment.
Yeah, so when we think of the 70s, basically there was monetary dominance, meaning you had smaller public deficits, smaller debt levels, and so those monetary levers were a lot stronger. When you get the fiscal dominance, there's a couple ways of looking at it, but basically that fiscal is what's overriding things. Monetary policy gets less flexible because they're being overridden by basically the large fiscal forces that are at play. Very large public debts, very large public deficits. And so fiscal changes, so like tax increases, stimulus, that kind of thing, end up being far more important for the economy and for financial markets than central bank decisions.
Okay, let me ask you this. So if the accelerator wins out in this battle, the fiscal accelerator, What impact does that have on inflation?
So
Especially if the
that
has to eventually take its foot off the brake too at the same time.
I think that would be the risk for a second wave of inflation. So we've had, inflation historically often comes in waves, where you have inflation, then you get under control, but the underlying force is still there, and as soon as you kind of, stop suppressing it, it comes right back. It's like holding a volleyball underwater. You let go, it comes back up for a second bounce. Um, and there's really kind of, I think, two main ways that can happen. One is some sort of energy supply disruption, which, considering how tight the market is, any given week or month is always a possibility, especially given some recent events. And the other one would be basically if the Fed is no longer able to tighten their balance sheet despite above target inflation, um, then basically the market can lose faith in the Fed's credibility. They can have a very kind of different view of how things are going to turn out. And then we start going to, I think, the more Japan route, where even when you're above target inflation, you're still doing QE, um, for lack of a better thing to do. And then I think especially when you're in a an environment where you're also running a trade deficit, and you're in an environment that's more of a tight commodity market, which was say not the 2010s decade. So Japan, a lot of their central bank balance sheet expansion happened from say late 2012 to the present. Most of that was in a commodity bear market. Whereas if this type of thing happens in a commodity bull market or a tight commodity market, especially a tight energy market, that combination can be quite inflationary and give you the second round of potential inflation.
Okay, so we've heard a lot that the Fed is fighting for its credibility here, right? And that Jerome Powell doesn't want to become another Arthur Burns, right? You keep mentioning the 70s as sort of a comparable, somewhat comparable historical complement here. It sounds like if Powell is really trying not to become Arthur Burns, he's got to be pretty angry because it seems like Congress and the administration are trying to force him into an Arthur Burns type role with this extreme, fiscal spending, right? I mean, basically, I'm sure if Powell had his druthers, he would say, "Guys, cut it out because you're going to make inflation come back. That's what I'm trying to kill."
Yeah, and I think, I mean, what adds complexity here is a lot of what we're seeing in the fiscal deficit was baked into the cake years and decades ago. And that's one of the big problems with fiat currency is that you can defer problems, and then basically the consequence is so far separated from the cause. So right now, for example, in political spheres, you'll see people arguing, is it Biden's fault? Is it Trump's fault? That because it's very recency focused. But for example, like I mentioned in my book, the Iraq War is estimated to have, I mean, the whole war on terror is estimated to have cost like $6 trillion when you include the war funding, the interest expense since then, veterans benefits for the next decades. When they kind of extrapolate that out, they get to estimates of like 13 trillion by 2050. And that was before interest rates are where they are now. So if they're just more structurally elevated, that's gonna be more trillions. But no one ever kind of sees these current fiscal deficits and goes back and thinks 20 years ago
Mm-hmm.
or 40 years ago, based on just demographics and things like that, right? So both from the demographics entitlement standpoint and just some of our geopolitical decisions that have accumulated not just in the past 3 years, but in the past 40 plus years, um, that's all removed from their original decisions. And so that's why I kind of just view it as there's not like it's not as though Congress passed a lot of big bills right now. A lot of this is kind of baked into the cake from, you know, during the pandemic era, but then also before then, there's just so much accumulated. And it was kind of like always going to come like this. And then the question just became, is it pulled forward, which it was
Mm-hmm.
because of some of these recent, decisions over the past three plus years, or is it going to be pushed away as it maybe could have been, but wasn't? So yeah, I think Powell would be annoyed at, the fact that they're trying to, tighten overall conditions, but there's not much they can do about the deficits that are coming out that are stimulatory, uh, kind of inflationary, and then potentially make the Fed's job a lot harder in terms of being able to control their own monetary and their interest rate policy and their balance sheet size.
Okay. It's interesting hearing you talk. You're kind of giving the fiscal side of an argument that I've heard Rick Rule give quite frequently. And in fact, I just interviewed him the other day for Wealthion's upcoming conference. That's this coming weekend. Folks, don't forget to go register for that if you haven't already. But Rick talks a lot about, he's a natural resources investor, and he talks a lot about, for a lot of key commodities, we are, even if demand remains constant in future years, we're sort of destined to have pretty strong supply shortages because of decisions to underinvest made 5, 10, 15, 20 years ago, right? And that's been traveling through time and is now catching up with us. Sounds like you're saying there's a very similar dynamic on the fiscal side of things.
Yeah, a lot of these things come in longer cycles. And like I said, that's the main selling point of fiat currency is the ability to separate consequences from the point of decision by a sufficiently long timeline that it's
Which is why
murky.
politicians love it. Yeah,
Yeah,
exactly.
and so that's what we find ourselves in right now. And the United States has had the most leeway to do this, and so they've done it the most, pretty much, at least among the developed world. And so they are, they're kind of running these very large deficits as though there's no consequence for it. And I think, in the years ahead, we are going to start seeing more of those consequences.
All right. And it's probably going to get, one of the reasons why is multifactorial, but one of the reasons why, if I intuited correctly from your earlier answer at the beginning of the conversation here, is that, unlike the 70s, we have much more debt now, right? So we have a much higher debt burden, which limits our options. And that debt is becoming quickly much more expensive, right? And so that twin combination here really just, it makes a lot less possible. You agree?
I agree, and that's also why I compare this period to the 1940s a lot more than the 70s, even though the 70s does have some similarities with, for example, potentially energy shortages and things like that. But the source of money creation and the debt levels are much more like the 1940s, which was the more fiscally dominant environment. And basically, if you sum up the current predicament, is that we spent 40 years getting higher and higher public debt to GDP ratios from the 70s. And then we spent 40 years, starting with Volcker, having downward interest rates. So he got them to that super high level. We had 40 years of declining interest rates. And so, if you double your debt, but you have your interest expense is still the same. And so that's kind of overall the rough situation the United States has had, where the increasing debt burden didn't really matter because it was always offset by falling interest rates. Um, and if you look at when kind of like the public zeitgeist around the debt, so in the late 80s is when they put in the famous debt clock. Early 90s is when Ross Perot had like the most successful independent run, and his whole big thing was like the debt and deficit.
Yep.
And that period was still very high interest rates and basically rapidly increasing interest expense. And so there was kind of like this like outcry. But what happened was, when Soviet Union fell and China opened up throughout the 80s and especially the 90s and 2000s, we ushered in this like 30-year period of globalization. So we brought Western capital and Eastern labor together. We built all these facilities throughout Asia. Russia connected all sorts of increasing energy, cheap energy to Europe. There was like a lot of these disinflationary forces that were really opened up for like a 3-decade period, and they enabled disinflation, falling interest rates, combined with central bank decisions to always keep lowering them. And that result was that though the debt concerns were kind of like 30 years early, because they basically what they didn't assume was the interest rates would fall all the way to zero and then stay there for a while and make that debt servicing cost more manageable. The problem now is that when you after you've exhausted those 40 years of declining interest rates, you go to zero for a while, you bounce off zero. Now we still have the debts and deficits that are rising, while we also have now interest expenses not going down. And so that's where you start to actually get more acute things associated with those fiscal problems, much like it was back in the late 80s, early 90s, except this time there's limited ability to kind of offset it again.
Hmm. All right. Well, so obviously, we're sort of increasingly entering this box canyon, probably both monetarily and fiscally. Begs the question, what can we do, if anything, to get out of it? Let me ask you a few more questions, and then we'll dig into that main one, that question I just mentioned there. Um, I guess first off, just to get your full perspective on the table here for folks, what are your thoughts on what has just happened, the import of what has just happened in the Middle East, both societally and for the global economy? How big of a risk factor do you currently think it is? And I just want to note, you're not a geopolitical analyst, not trying to put that burden on your shoulders. You do spend some time over, near that area at times. So, you've got a bit of a more boots on the ground, informed perspective than the average American. So very curious to hear what you think.
Yeah, like you said, I'm not a geopolitical expert. I cover this mainly from a monetary standpoint and energy standpoint. And then, yeah, personally, my husband and I go to Egypt every year. That's our second home. We have family and friends there. And so even right now, I have family that's, about 250 miles away from what's happening there. And of course, Egypt shares a border with Gaza. They're very tied into what's happening there culturally. And
They may be
this
taking in a bunch of refugees soon. I think that's trying to be worked out right now. Yeah.
we're going to see what happens there, and that's while Egypt is having its own currency crisis. Essentially, it's got a ton of external debt. It's currently going through an IMF restructuring, um, and they've got 38% official inflation, so somewhere around that ballpark.
Wow.
And they might have to do another currency devaluation going forward. They've been kind of doing their best to kind of keep that currency pegged for the past year. And so they have a lot of their own internal issues that they're working through, and now they have this on their doorstep. In terms of broader geopolitical significance, I mean, this attack was the 50th anniversary of the start of the Yom Kippur War. That's also associated with the energy shortages we had in the 70s.
Hmm.
And so this is obviously there's a lot of potential here for a problem. But it's, these things, there's a lot of outcomes that are hard to predict. I mean, basically, from an oil price perspective, whatever probability there was of an oil disruption before this happened versus now, that probability is higher now. It's hard to say what that probability is, but it's whatever it was 2 weeks ago, it's higher now. Um, we hope that cooler heads prevail and that this doesn't escalate beyond its own borders. It's already a humanitarian issue enough, let alone if it were to become a more geopolitical thing when you have more countries involved or contributing to energy crises because, certain suppliers have been damaged or something, right? So that's the scope of how this can go. But I think also the issues it ties to my prior point that as America kind of runs into these fiscal problems, has been hollowed out. The public is increasingly polarized, less interested in the rest of the world. So as we kind of pull back,
Hmm.
um, that ushers in a more multipolar world. And so, like I said, now the United States is involved in indirectly, really in two war fronts. We also never know what's going to happen with Taiwan, really.
Hmm.
And things tend to kind of feed on themselves, but hopefully nothing happens there. And so I think that basically we just have to expect that most geopolitical things are probably going to surprise to the upside in the years or decade ahead. And that there's in some sense more things that can go wrong than right while you're in the midst of, reshuffling of global alliances, global capital access, that kind of thing. And so I don't really have a firm view on what's going to happen there. I hope not much happens there more than what's already happening. Um, but we have to wait and see. And I've been bullish on energy for a while now, and this type of thing only adds to it. I mean, it wouldn't change too much from where I was 2 weeks ago, but these things just keep adding up to the risk of energy security in the years and decades ahead. That both has investing implications and just humanitarian implications. If we do have energy security issues, energy spikes, real people around the world, especially in developing countries, suffer from that.
Um, Good answer. And let me just end with this because I feel like I'm going to be asking this question a lot this week. Um, has the risk premium for the global economy just raised as a result of this?
Yeah, and I think all else being equal, there's more risk than there was. This has all that obviously that this is nothing particularly new. I mean, these events are escalated compared to other things that have happened before. So, I don't think many investors should go out and just radically change their investing profile because of this. From my standpoint, this type of risk is already assumed to some extent, which is why I'm bullish some of the things I am,
Hmm.
why I'm bearish some of the things I
Kind of a
am.
validation of some of your existing positioning.
In a bad way, sure, but I think
Yeah.
yeah, basically whatever geopolitical concerns there were before are now elevated by some amount that, it's hard to quantify that. That's what markets are for. We're seeing that kind of priced over time.
Okay. All right. Well, look, I want to get back to this rising risk premium. So we've seen bond yields surge pretty dramatically, over the past couple of months. And interestingly, equities, they're still doing pretty well for the year, right? It seems to be a tale of two assets, or two assets telling two different stories, if you will. It seems that bonds seem to be telling a much greater story of worry than stocks are right now. And I'm curious, do you have an opinion on which side is sort of seeing things more clearly?
So I think one way I'd phrase it, I would view it less as worry and more as a mechanical issue, basically just too much supply relative to the types of demand that can absorb it in the treasury market. And so it's not necessarily that a lot of treasury investors are saying um, these prices aren't good. It's that they're saying I literally just don't have the balance sheet capacity to absorb this fire hose of treasuries. And the strong dollar just kind of mechanically brings the foreign sector out of the treasury market purchase period for a while. So even though some of them say might want to accumulate treasuries, just it's not the environment where they're easily able to do so. Banks can't, and then the Fed's choosing not to because they have their mandates that they're trying to follow. So a lot of this is just mechanical. Um, I have been somewhat surprised by the resiliency of the stock market this year. Um, on one hand, it's not surprising in the sense that I've been in the camp that things like stock market and real estate in aggregate are going to be in this choppy sideways range for a while. So I was not one of those people predicting a big crash, not one of those people predicting like a melt up. My view is generally in that choppy nominal range, which is not good for just, year after year of real returns.
Mm-hmm.
And so this has been in line with that in the sense that we had a dip, we had a rebound, we're not at all-time highs. And so that plays out. But when I had made that prediction of choppy markets, if I had also known that treasuries would have gotten this high of a yield, then I would have assumed that as some of these big growthy stocks would have their multiples compressed more than they have now. So I'm a little bit surprised by the resiliency of the equity market. I've been a bond bear since like 2019, and the severity of this bond bear market has been surprising to me as a bond bear. Like I was not bearish enough on bonds. Um, and so I do think there's a little bit of a disconnect. It kind of reminds me of like February 2020 when commodity markets and other markets were sensing the issues that were building in February 2020, and like in China and things like that. And the equity market was completely in la la land. And then eventually just went straight down. Like it was just like a comical once it realized that all that stuff's kind of coming to our shores, equity market goes straight down. Um, I don't necessarily, I'm not talking about anything that extreme, but it does feel like there's that disconnect where equities don't care until they do.
Okay, so they're forced to. All right, so on the bond side, just to repeat, it sounds like you're saying it's not you don't see this as an emotional driven response by bond investors. You see it more as a mathematically driven one. And you've mentioned the supply, the flood of treasuries. Uh, how much of that is due to the Treasury refilling the TGA? And the reason why I really want to put a spotlight on this question is the last time I had you on, you said, hey, they're kind of stimulating the economy in a stealth way by draining the TGA down, the Treasury General account. And at some point, that's going to have to be refilled. And that is going to push a whole supply of new treasuries into the market. So you actually called what's going on right now.
Well, so I'll avoid doing that like kind of victory lap because it has been pushed back a little bit in
Well,
the
I'll
sense
give it to
that
you.
well, so one thing that the Treasury did well is that so I was concerned that there could have been a more acute liquidity issue this summer based on how they choose to refill their TGA, and that part did materialize in the sense that they mostly focused on T-bills to refill the initial burst
Hmm.
of it, which was kind of the most dangerous part of it. Like when you go from zero to like 400 billion, they navigated that. And that was one of the factors I said they could do if they want to avoid a liquidity issue. So basically, when the Treasury issues securities, they have all these different mandates for what they're trying to optimize for. They want to lower costs for the government, but they also want to ensure good functioning of the Treasury market. And so they basically chose to issue more on the expensive side of the curve, which was the short side, in exchange for that's a better liquidity situation because that can come out of the reverse repo. And that's exactly what happened. Basically, as the TGAs filled up, the reverse repo facilities come down. And so they've kept liquidity pretty flat since the March banking crisis. So like reserves are not being drained anymore. They're not being refilled either, like bank reserves.
Hmm.
Basically, it's you've had this kind of like seesaw. We're kind of seeing the second phase of it now in the sense that now they're back to coupon issuance. And so this starts to look more like how it could have looked had they not done that initial burst of T-bill filling. This is so basically they avoided kind of the first few months of a problem, and now they've kind of run into that now. It's still not acute enough. Like there's no seizing up in the treasury market. There's been elevated move index, but there's not quite acute signs. The treasury market became very kind of illiquid back in autumn of last year, around the same time, right before the gilt market blew up.
Hmm.
Um, I would say most signs are showing that even though the yields are worse, the treasury market is not quite as problematic as it was back then, but it's directionally been in that general direction. So, um, this is kind of like an ongoing issue. And one thing I actually wrote a newsletter called Treasury Market Dissonance back in August 2020. That's back when yields were almost zero on the long end.
Hmm. Different
And
world.
yeah, different world. And one thing and the reason I called it is because I started to see a supply issue forming back then. Um, and so it's obviously been a big zigzag to get there, but that was kind of the top of the bond market, and it's only been this like shocking fall in bond prices, shocking increase in yields. Um, and that's unusual for investors because when you look back at the 2010 decade, one of the unintuitive things is that when the Fed was doing QE, bond yields often rose. So they start buying bonds, and instead of driving those bond prices down, the bond prices, instead of driving them up, so bonds up, yields down, actually the reverse happened. But that's often because the private sector would then rotate into more risk assets. Basically, a liquidity injection was seen as a risk-on environment.
Hmm.
Um, but that started to change, starting kind of arguably with the repo spike, but then especially during the March 2020 sell-off, where we started to see more positive correlation, where the Fed buying does actively suppress bond yields, and when they stop buying, those bond yields push up. And so we are in this new regime, and so that kind of observation has been confirmed over the past few years compared to what the 2010s were like. So in some cases, this is a more intuitive regime because it kind of works as you'd expect it to, rather than the reverse of how you'd expect it to.
Okay, so there are a fair amount of people that are looking at the bond market right now and saying yields are really high. Bond market is looking like it's going to have its third consecutive year of losses, Treasury bond market, which has never happened in U.S. market history. And as long as the Fed remains higher for longer here, at some point, the odds of something breaking, right, and requiring the Fed to step in and rescue grow, right? So there's sort of a whole bunch of factors where people are saying, okay, I don't think we're that far away from an environment where bond yields could start coming down for a variety of reasons. But of course, if something breaks and the Fed has to step in, they are expecting that the Fed would step in and buy bonds, and that would immediately send bond prices up and yields down. Um, Maybe you feel that way. Maybe you feel, yep, we've come into this more intuitive era where if that indeed happens, that would be the expected result. But I'm curious, what would you say to those bond investors who are sort of looking at bonds right now saying, hey, this might be a really great bond buying opportunity. And not everybody thinks that way, but I've certainly interviewed some people who think this is one of the best times to be buying long duration treasuries of their career.
So I mean, after such oversold levels, I can see why there's a lot of interest in bonds. So I'm less bearish on bonds now than I was like, a few years ago.
Back when you wrote
Um,
that 2020 article.
yeah, and so there are more interesting opportunities around in the bond market. Um, because I have a more inflationary view of energy, and because I'm still concerned about the ongoing supply demand characteristics of the bond market, I personally am not really rushing into, for example, go long bonds. I think the most interesting area of the market is probably tips. I do think that from a real yield perspective, there's some opportunities there. So you might say, well, I'm not necessarily bullish on nominal bond prices, but you could be bull I could make the bullish case for why real yields probably are not going to go much higher, or
Not
if
going
they
to get any
do,
better.
yeah, if they do, maybe that's a second tranche, you buy a little bit more. But that they're not going to structurally just keep going up because that's how things break. So I do think from a real yields perspective, like a tips perspective, I think there are some opportunities. Um, when you get into the nominal territory, I mean, I'm sure there's tradable opportunities, but it's not exactly a market I would rush into to get involved with. Um, and I do think that we're in that more intuitive regime. I mean, we already saw that, when there was a banking crisis, the Fed did jump in to kind of put out fires where they could. And, what they're not going to do is if inflation's above target and the equity market falls 10 or 20%, that's not going to cause the Fed to do anything.
Right.
If a bunch of real estate developers go bankrupt, the Fed's not going to do anything. It's only if basically something like the treasury market or something very adjacent to it has a problem, banking, treasury market, that kind of thing is where they jump in. Things where you can actually get contagion pretty quickly. Or two, if you do get like outright recessionary conditions, then you probably have a repeat over again. So I don't think that people should expect the Fed to rush to the rescue. And I also think that when they do have to rescue, they would do the minimum that they can uh, to kind of put the fire out. But if inflation is still the problem, they're going to still want to be tight around the margins where they can be, which is not necessarily as good for asset prices as if they just throw the like a liquidity bazooka at the problem.
Right, right. God, so many great questions. I'm looking at the time here. I hope I can get through most of these. So talking to Alf Peccatiello relatively recently, he has a very similar perspective, I believe, as you, Lynn. And he's basically said, look, if Fed's playing for its credibility here, it is going to do whatever it can to either get inflation down to 2% or lower, right? And be able to say, okay, everybody, we did what we said we were going to do. Or only pivot essentially when the world comes to an unbended knee, right? When there's something super systemically important breaking, like the treasury market or the banking system, and the world comes and says, Fed, we know you're trying to get inflation under control. We think that's a noble goal, but this problem is bigger. Please pivot now. Sounds like you're saying sort of you have sort of a similar expectation where they're not going to be a glass jaw at the first sign of trouble that they're going to start intervening again. So basically Alf's predict or warning was, folks, be like, there's a decent probability the market's probably going to take some pain at some point here in the future because the Fed's not going to come to the rescue until the 11th hour. Do you feel the same?
I think that's a way to look at it. And I also think you have to counterbalance that with how much fiscal is happening. So I'm not like uniformly bearish. I'm more just like selective with the risks I want to take in this
Yep.
market. Um, and I mean, the Fed's been very interesting. I mean, if I kind, I've got a number of calls right in the recent years, like calling for inflation, being bearish on bonds, that kind of thing. The thing that was somewhat surprising to me that if I go back a few years, I would not consider be correct is that I did not expect the Fed to be as hawkish as they have been. I thought they would use kind of the COVID era as more of a excuse to not raise interest rates despite high inflation. I thought they would try to push that longer.
Perfect get out of jail free card. I don't know why they
Yeah,
didn't use it. Yeah.
because they're basically in an environment, and that's why I studied the 40s a lot, where they're in a situation where in the long arc of time they're going to be more like Japan in the sense that they just kind of run out of room to do what they want with interest rates and balance sheet, despite being even when they're above their inflation target. And that was an environment where they could have turned to that, and I assumed that they would have. But because of who's running it, they were more hawkish than I thought. So even though inflation and bonds kind of went the way I thought, we've had a firmer dollar than I would have guessed, and a more destabilized banking system and weaker gold prices than I would have guessed, at the same time, say 3 years ago. So it's directionally playing out a lot like I thought with a couple main caveats, and that's why it's important to kind of respond with new information as we get it. And
Mhm.
so it's clear that the Fed is going to try to push things as much as they can because it is a credibility issue. And I think they should be applauded for that. It's kind of like they're proving that it's not necessarily on them right now, that they're going to try all their tools to be hawkish, and only if the fiscal basically forces them otherwise, um, that's when I think that they would have an issue. Until
Yeah.
then, I think they're going to try to keep keep a lid on inflation, try to get it back down to 2%, up to and including causing some degree of recession, up to and including basically just letting most things have problems other than like the treasury market.
So, did I hear you correctly, though, in regardless of if the Fed does exactly that, that it's going to be somewhat of a Pyrrhic effort, meaning, you know, what's going to matter more at the end of the day is what's happening on the fiscal side, which is essentially going counter to what the Fed's trying to do?
Yeah, I think that's how I read the situation. And I think the
So do
basically
we
the
do we kind of feel bad for Powell in a certain way? Like,
in a certain way, I mean, he
yeah,
inherited a lot of this. I think instead of going down as Arthur Burns, he can go down as the one that tried his best to push back against the unstoppable object of fiscal. Um, I think that's kind of that's the outcome that's like most workable here. Um, and I think that's kind of what I think that's what we're seeing play out.
okay. Gosh, it feels strange to have the words "let's have some sympathy for the Fed" come out of my mouth, but I think it's very important that you're unstoppable for the juggernaut of fiscal dominance. Maybe the thing that really matters here in the long run. Very quickly, uh, just to get back to bonds for a second, a big part of what's driving the factor right now, you're saying, is the math of sort of this the supply math. I'm trying to avoid saying oversupply math, but if you think it's oversupply, please say that. How long do you think that wall of the supply glut will last? Are we talking months, a quarter or two, or is this a kind of a years long thing we should be looking at?
So I guess I would use the term oversupply if something acutely breaks. Until then, it's just a lot of supply, um, and the supply is essentially endless. I mean, this like I said, the deficits are structural for years and decades. It's almost written in stone at this point. I'd be very surprised if there's some sort of grand bargain to arrest the deficits. And then ironically, even if they did, austerity can prevent you from getting very high debt levels. But it actually is a low success rate when you already have very high debt levels.
Mm-hmm.
Because if you have a very financialized economy and then rein in the fiscal deficits, you can end up slowing GDP, hurting asset prices, and then U.S. tax receipts are so tied to asset prices
Right.
that you don't reduce the deficit nearly as much as you thought you would.
Right. And
Um,
everything just starts breaking, and
yeah,
then all you get is more stimulus at the end of the day. Yeah.
So I view it as low probability they can get the fiscal under control in any sort of foreseeable future.
And sorry to
Um,
interrupt, but does that mean like multi-trillion deficits are just like here to stay? Like we're never reining things back in?
I think so. That's my expectation. Now, obviously, there are some things that can influence that. Like if we have a recession, the interest rate angle to that would probably decrease a little bit, but then the tax receipt angle would fall too, and so you,
Right.
you might moderate. I don't necessarily think that we're going to spiral out of control in like years. I just think it's a long grind. Um, Now the question is the demand side. Are there things that can affect demand? And I do. I mean, basically, if you do see some softness in the U.S. economy, changing expectations of the Fed's forward interest rate moves, if you do get that kind of weaker dollar, then foreign treasury accumulation, at least around the margins, can reoccur. And so basically, there are ways to kind of have a cycle to kind of calm this down for a period of time and go further. So I think the supply is practically endless. The demand is fluctuating based on questions like what is the dollar doing? What is the Fed doing? And those are basically kind of the same question. Um, and I think that's a cycle to watch going forward is what are some of these demand factors going to be? And then if you do get any sort of energy problem, that feeds into that makes it also hard for the foreign sector to accumulate treasuries. Whereas if a lot of new oil supply were to come to market, even though we don't really see visibility for that, that can alleviate certain things and that can make the Fed's job a little bit easier. So I think there are some factors around the margin that affect this, but I think the long-term outcome is kind of written in stone.
Okay, but if you're looking at the bond market and you know hoping for lower bond yields, what I hear you saying is that's probably going to be more dictated by demand than supply.
Yeah, basically, if they can get more out of the equity market and into bonds, which again, I would not want to, that'd be a challenge for a 60/40 portfolio, even though it might be good for the bond side temporarily. Um, or if one of these other factors can give more foreign demand. So I think it's traders are going to trade, um, but it's not exactly a market I want to rush into. Other than that, I do think the tips angles are increasingly interesting at these real levels.
Okay. All right. In the remaining time we have, Lynn, I want to talk about this great new book. So you recently released a book that you wrote, I think it released in August, titled Broken Money, which, as of this morning, is still selling really well on Amazon. It's number one in banks under the banking category. It's number two in money and monetary policy. So first off, congratulations.
Thank you. This has been like a long journey to get that book out.
Well, it seems like it because you take a long journey. I mean, you explore the history of money, from the very beginning, but you look at it, which I found really interesting, which differs from a lot of other books on money that I've seen, because you kind of look at it all through the lens of technology, right? So, a couple questions for you about the book, but I guess the first one is, why'd you write it, and why release it now of all times?
So I wrote it, I guess, for two main reasons. One is because I've written so much research, naturally I get questions like, are you going to write a book? Or I think like, could some of this make a book? Now, books are a lot of work, and they're not really good ROI compared to other things you could be doing, like
Yep.
research-wise, investing-wise. My first advice, and I knew this going in, don't write a book unless you have to write a book. Like a book just it wants to come out so much that
Hmm.
you just that's your highest calling in that moment. So that's what happened to me, which is kind of like it wasn't a decision to write the book. It was like the book kind of materialized in my head and then made the decision. And basically it was all written in a year because I had years of prior, research to draw from. And, basically it was like a couple key things, like realizing we need a book that's, kind of the history of money through the lens of changing technology. As you said, it's not something that's widely explored. And also a couple main themes along those lines, like the how the speed of transactions has changed over time relative to the speed of settlements and the implications that has for various power structures. Um, Two, kind of like analysis or reconciliation between different types of monetary theories, like the credit theory of money versus the commodity theory of money, and a way to kind of tie those together. And then lastly, exploring why there's 160 different fiat currencies. I feel like this is a problem that, from both an investing standpoint, as like an opportunity, and as humanitarian aspect in terms of like why is money broken? When you look at the fact that there's 160 different currencies in the world, and it's kind of a luck in the draw of which one you're born into. They all have their own local monopolies. Most of them have very little acceptance outside of their jurisdiction, and most of them rapidly lose value. So people get kind of trapped in these currency bubbles, and it's kind of like saying, okay, how did we get to this point? Because this is clearly not optimal. I mean, when you have 40 currencies in Africa and 30 currencies in Latin America, that affects trade. And but then it's like, well, what other better option is there? Because gold has a lot of use as a savings asset, but it's in order to move it quickly, we have to abstract it in some way,
Hmm.
which is how what we used to do, and then or you basically have a central bank or a country kind of running a currency system that multiple other countries use, but then that takes away their autonomy. And so there hasn't been really good solutions for this. So it's kind of like I like the idea of exploring why this setup exists, exploring the problems it causes to people. And I draw to some extent from my experience in Egypt, people living in an environment where year after year there's 20% money supply growth, and what that effects that has. And from their perspective, just this is the currency bubble that they're in, and there's many like it, and there's some that are worse, many that are better. Um, and just I just found that money is a topic that's not well understood, that could be explored in a detailed but accessible way, um, in a way that I've not really seen other books cover.
All right. And folks should go read the book, and Lynn will have the link to your book in the description below this video, so folks can go click on it and buy it. But what are some of like the key takeaways you'd like them to leave from having read the book with?
I think a couple key takeaways are a mental model of thinking about money. So people say, is it metal? Is it people say it's an IOU? Like, what is money? I think one way of thinking of it is money is a ledger. And so you have to be very careful which ledgers you choose to trust. So that, basically those who control the ledger, if anyone controls it, can dilute you out of it, or can freeze your ability to use it. And so when you think about money as a ledger, whether it's a literal ledger like a central bank currency, or whether it's nature's ledger like gold, or a more inflationary commodity like copper, for example, you have to pick your ledger carefully, and they have different characteristics. And it's an interesting exercise to walk through, you know, what ledger am I using, who controls it, and what else could I be using? Um, and I think another takeaway is to realize that for a century and a half, we've had increasing transaction speeds compared to the physical world. And so it's kind of necessitated more and more centralization and abstraction. But that has also brought with it a lot of the problems we've just talked about. Basically, fiat currency, inflation, almost like currency barter on a global scale.
Mm-hmm.
Money is meant to unify transactions, but if there's 160 different monies, it almost like is failing in that way. And then the last one, like I explore kind of the fork ahead for money's generally going more digital, but that takes different forms. So, for example, there's open source money like Bitcoin. There's central bank digital currencies that kind of further the control. And then there's like hybrids like stable coins, which are basically ways for like one country's currencies or assets to pierce any of those 160 different, financial barriers around currency blocks, and basically give those people more options. And so if you're living in Nigeria, for example, generally what you want is something, your options are real estate in the local area. You don't want to hold the local currency. The stock market's not as, the capital markets there are not as developed as you're going to get in the US. It's not like you just go out and invest in the S&P 500. And so people are stuck in their not just money silos, but like capital silos, unless they're wealthy enough to have like foreign accounts and things like that. And one thing that technology can do, if we let it, is give people more global competition, more global access to the best assets in the world, rather than be restricted to whatever assets happen to exist in their own jurisdiction. So it increases if people want to hold dollars, if people want to hold maybe the S&P 500, if people want to hold Bitcoin, if people want to hold a gold stable coin, these are ways to, it's almost like offshore banking for the middle class, is what some of these technologies can do. And
Mm-hmm.
so I think a big takeaway I have is that there's a fork in the road between either more centralization, basically for a century and a half, we've made the system more and more efficient, but more and more centralized. And we can either continue that path with CBDCs, which I would advocate against, or there's the more open path of actually trying to tie these systems together more, make capital more globally portable and accessible in the more open source way.
All right. When I read the introduction for this video, Lynn, I had that quote from Buckminster Fuller, who really, is saying if you want to replace the current model that everybody's using, you can't just attack it. You've got to build a better model and show them what it looks like. Do you have hope? And I think this is a leading question, but do you have hope that some of these digital solutions are indeed presenting the world with better models?
I do. I think assets like Bitcoin, as well as things like stable coins, give people more choice in either sometimes in developing countries and also developed countries. And I have hope in the sense that I mean one of the work I do is I work with Ego Death Capital. We do venture capital in this area. Um, and so we're basically get to meet founders who are building companies, trying identifying some sort of monetary problem and trying to solve it. And so there are people out there, um, in a decentralized way, saying, okay, here are these frictions, here's areas where money's broken. Um, what can be done to do that. And so when I see people doing work like that, and getting to meet them, that does give me hope.
Do you think that, let's say like 100, let's go fast forward 100 years, when they're looking back in the history books at this point in time, will they look at sort of this moment in time as sort of probably the way for money, the way you think, they're already beginning to look back in time into the 70s and 80s with the emergence of the internet that, changed the world starting in the 90s?
I would like to think so. I think they would look back, kind of like how we look back, in older technology times and think like, why were things like that, or what would have life been like in that environment? I would like to think that far in the future, people will look back and just think like there were like 160 different currencies, and people were just dealing with like 20%, annual currency supply growth just year after year, and just couldn't do anything about it. And like what an insane situation. Or just the overall general policy of due to technology driven deflation. So on average, we get marginally better at making things year after year. Um, and yet, so prices should go down, slowly over time. And yet central banks do everything they can to make prices go up over time. And that has all sorts of semi-invisible issues throughout society. It warps, money is ever since, Hayek explored this topic, money and prices are a signaling mechanism. It's how we come to consensus on things. It's an efficient way to share information, money and price, transactions. And by messing with that in a centralized way, um, that has implications. And so I would like to think that, yeah, people will look back on this period and think like this was a local maximum. This is not the best that money can be. And that this was also a period where a lot of things emerged, which hopefully, 10, 20, 50, 100 years from now, I would hope that it's a better monetary environment than there is now.
Okay. And last question about the book, which is just where can folks get it? And pretty much anywhere books are sold.
Yeah, you can. Amazon's the easiest way. We're working on more bookstore distribution. You can also go to the safehouse.com. That's SAIF. He has some of the books as well. It's like an online bookstore. So yeah, basically Amazon's generally the easiest.
Okay, great. We'll put the link down below, like I said, and we'll put the safehouse.com URL up on the screen when we edit this, Lynn. I realize I neglected to ask an important question that folks will have wanted me to ask. So let me ask that, and then we'll wrap things up. What's your current market outlook looking into 2024? And are there assets right now that you particularly favor and ones that you just wouldn't touch with a 10-foot pole?
So I think that as long as we're still in this situation where the Fed is trying to tighten, um, risk assets have a very mixed outlook. And there's all sorts of things like basically if in the next 8 months we either do have an energy crisis or we don't, that'll obviously affect things. Like, almost every prediction has a Boolean outcome based on energy prices. Um, and so, like I said, I'm increasingly finding tips interesting. I do like gold and Bitcoin as long-term accumulations here. I don't necessarily expect fireworks while we have this tightening situation. Um, and I would be cautious around overall equity exposure. Um, I think T-bills are interesting. I mean, as long as you can earn like over 5% on these types of assets at a time when money supply is not growing quickly. Um, there's this window here where I think that makes sense. When we look out longer term, I would expect by maybe late 2024, maybe 2025, we probably have another positive liquidity cycle, and I would want to own, more liquidity driven assets.
Okay, great, fantastic. All right, Lynn. Well, look, this has been just again It's always a wonderful discussion when you're on. Thank you so much. To your point about money, let me just toss one quick idea out here. I've had recent discussions in the comment sections below these videos where there's some percentage of the viewership. I'll say the Wealthion viewership isn't like a massive crypto audience, but there is curiosity about what's going on in the space, and there's been some requests for somebody who can come in and kind of give an update on what's going on in the space, but not somebody who's, you know, so just philosophically wedded to whichever particular crypto they're invested in. They want somebody who's as open-minded as possible. You totally fit that bill, and I'd love to have you come back on, and not necessarily just to discuss crypto, but to discuss sort of the future of money and the different, you know, models that are being built out there and the pros and cons and trade-offs of each. Is that something you'd ever be willing to come back and do on this channel?
Sure, I'd be happy to have that conversation. I mean, and it's one of those things where crypto has unfortunately deserved a lot of its bad reputation. I mean, it's, you know, when you bring a gatekeeper down, like if you decentralize media or decentralize book selling and things like that, it opens up doors, but it also opens up a long tail of basically bad products coming to market, right? There's no filter anymore. And this is basically what's happened to securities, where basically anyone can launch like a financial asset and try to distribute them. And so naturally, that's going to be a very scammy, hypey type of thing. But I do think underneath, around at least around the core of it, there are kind of powerful technologies that are worth knowing about. And like I said, I think kind of that Bitcoin stablecoin complex, as well as just the overall kind of development that's happening in cryptography. I just think that there is signal under the noise. It's just unfortunately there's a lot of noise in the space.
All right. Well, I really appreciate you being open to that, folks. I'll talk with Lynn over the coming weeks and months to see if we can schedule that. Maybe Lynn, what we can do is maybe we make it a live event where you come on and let you present whatever overall insights you want folks to know, but then we can just let the audience ask whatever questions it has, and you can be there just swinging at those pitches.
Sure, sounds good.
I really appreciate that. All right, Lynn. Well, look, for folks that have really enjoyed this discussion and would like to follow you in your work, where should they go?
So I'm at lynalden.com. That's where my main hub is. I'm also at Lyn Alden Contact on Twitter. And like we can find the book Broken Money on Amazon or elsewhere. That's the main places to find me.
All right. And again, Lynn, when we edit this, we'll put up the links to those on the screen. All right. Well, stay just for one sec, Lynn. I just want to let folks know about two quick resources. One, just a reminder, folks, Wealthion's fall online conference is coming up this weekend. You only have a couple of days left to register for it. So to go register for it, go to wealthion.com/conference. Best faculty we've had yet. I've recorded several of the presentations already. They are amazing. Hope to see you there on Saturday. And by the way, if you can't watch the event live, don't worry. Everybody who registers will be sent replay videos of the entire event, all the presentations, all the replay video, all the Q&As the day after the event, if not sooner. And then, as Lynn, did a great job talking about here, there's a lot to navigate going forward. If you're like most people, we highly recommend that while you're trying just to stay on top of living your life, providing for your family, that you work under the guidance of a good professional financial advisor who takes into account all of the macro issues that Lynn talked about here. If you've got a good one who's doing that for you, great, stick with them. But if you don't, or if you'd like a second opinion from one who does, consider scheduling a free consultation with one of the financial advisors endorsed by Wealthion. To do that, just go to wealthion.com, fill out the short form there. Only takes a couple of seconds. Totally free to have these consultations. There's no commitment to work with these advisors. It's just a free public service they offer to help as many people as possible, position as prudently as possible for what may lie ahead. Lynn, I want to thank you so much. Folks, if you'd like to see Lynn come back on, and if you're interested potentially in having her come back on to have that monetary discussion we talked about, please show your support for that by hitting the like button, then clicking on the red subscribe button below. Lynn, any parting bits of advice for the viewers today?
I mean, I think this is a time where there's obviously a lot of hardship in the world. And I think, the best we can do is try to do our best to support our communities, try to be good to each other online, try to just, add character to a world, because a lot of what I talk about can be like doomy, when we talk about like sovereign debt crises or energy crises and things like that. But it's important to know that crises have happened before. Crises will happen in the future, Life goes on, and you just have to do what you can to protect yourself while also living life, not always being concerned about things that you can't control, and just try to control the things you can.
That is very well said. And part of, I think, a sentiment what you're saying is the world is resilient, life is resilient, markets are resilient, and yes, take steps to minimize your ability to take losses, but don't necessarily develop a world is going to end tomorrow mentality and then miss out on the general recovery we tend to see through every time we get challenged in history.
Exactly.
All right, Lynn, thanks so much. It's been wonderful. Everyone else, thanks so much for watching.